market's moving, the noise is loud, and the question is simple. Should I keep buying, sit on cash, or wait this out?
My recommendation is simple. Keep dollar cost averaging, but slow it down a bit, and hold about 15 to 20% in cash. The market is expensive by historical standards, valuations are in the top 1% of history, but earnings growth, especially from AI, could still push stocks higher. So going all in is risky, and going all out usually backfires. The middle ground works best. Invest at maybe 70 to 80% of your normal pace, keep some cash for flexibility, and diversify beyond US megacaps. That way, you participate if the rally continues, and you're protected if valuations finally come back to earth.
The S&P 500 is expensive, driven by AI winners, and the easy money is gone. But going all cash doesn't work either. After inflation, you're barely treading water. So the move isn't panic or paralysis, it's modified DCA. Keep investing, but stop buying only the S&P 500. Shift new money toward cheaper, more defensive assets, mid-caps, international, value, and bonds. You still participate if markets rise, but you survive if valuations snap back. The real question isn't, will the market go up? It's, can you personally survive a multi-year drawdown? Optimize for survival first. Returns come second.
As of early 2026, the market is still near record highs, mostly driven by tech and AI optimism. But underneath, the signals are mixed. Valuations are stretched, leadership is narrow, and volatility is starting to rise. The Fed is likely moving toward rate cuts, but the path is uncertain, which usually means more market swings. Most major banks still expect growth, but with lower returns and a real chance of recession. So the rational approach isn't timing the market. It's to keep investing regularly, hold some cash for flexibility, and stay diversified.
The data says don't try to time the market. Keep investing regularly and keep a 3 to 6 month cash reserve. When you compare the options, buying, holding cash, or waiting, the expected value clearly favors disciplined investing. Cash gives you safety, but staying out of the market has the worst long-term outcome. So the balanced move is simple. Keep buying, keep some cash, and stay the course.
Right now, the numbers still favor staying invested. Historically, stocks beat cash by about 4 to 7% a year over the long run. Even with today's higher valuations, regular investing into a broad index like the S&P 500 still has a higher expected return, around 5 to 6% annually, compared to roughly 4% for cash, and even less if you just sit on the sidelines. The real risk is short-term drops. A bad year could mean a 20 to 30% decline. So the practical strategy is balance. Keep dollar cost averaging into equities, but hold about 10 to 30% in cash as a buffer. The key idea is simple. Timing the market is hard, and missing the upside usually costs more than staying disciplined.
Now that all 5 AIs have shared their perspectives, which one makes the most sense to you? Drop your thoughts in the comments, and if you want the full analytics behind each decision, the links are in the video description.